Hey, John here. Hope you guys are doing good. And this edition of the Deep Dive, I'm by myself going solo today. And so Drew is actually out traveling, meeting with clients all across the country. And so I get to go solo today. So we'll see how we do. And a lot of things I want to cover today. I'm kind of operating on three or four screens here. A couple things I know over the last 2 years, we have talked with a lot of you about different services, different things you really value and need as far as to make good, wise decisions. And we've been rolling a number of those out this year as we felt comfortable with partners. The first of which is high interest savings at the early part of this year. Rolled out Stone Castle, and so many of you have taken advantage of that as far as for your money that is sitting in cash that you're looking for protection or for emergency funds. 4.8% FDIC insured, up to $25 million. So phenomenal solution there. We also, a lot of you talk about really next two things coming up. First one is debt and trying to make sure that you are paying the cheapest amount of interest possible, lowest level of fees. We have just signed up with a firm and started beta testing them, and we're actually ready to start working with them with clients called Soro. And with the firm, they actually are a clearinghouse, and so we take all of your information, your social security number, and just some personal information, and go in and do a soft credit search for you. And on that, help you as far as identify your credit scores, but also lay out all of your debt. And then we go out and shop that to about over 100 different banks all across the country and having them compete against each other to decrease your interest rates. And so if you or a family member has loans outstanding, car loans, credit card debt, personal loans, house loans, and you're wanting to make sure you have the best rate possible, make sure you talk to your advisor about that. And so that's opening up right now. The next thing that we have heard from a lot of different people really is about Medicare. And so as you're approaching age 65, for most people, if you're on disability, it may be sooner than that. But for most people age 65, the medical solution that you have is Medicare, and trying to make sure you have the proper supplement package, proper setup on Medicare. And we've worked with a tremendous partner firm over the last number of years, and we've actually learned a lot from them, and we've actually brought the solution in-house. And so Nicole, out in our Avon office, is a specialist in Medicare. She'll be working with clients all across the country and really focusing this fall on Colorado and then also for the state of Illinois, and then expanding throughout the rest of the country later on this year. If you are not in one of those two states and you do have questions, we definitely still have our resources available to help you out as far as in the states where you live, the way that we have for the last 2 years. And you'll find out in the body of the email really more information from Nicole. And she has a video in there which talks about Medicare. So no matter where you live, phenomenal resource. Definitely check that out. A couple things coming up real fast as far as on loans. Mortgage rates, they hit a 20-year high here in the last 3 weeks. And looking like interest rates are going to go up one more time here in the month of November. And then they're going to hit a pause and wait and see as far as with what happens with interest rates. And so if you have a low interest rate loan, you want to keep that in place. But if you're looking as far as on refinancing right now, you might want to wait or definitely check out the solution we have with Soro to make sure you're getting the best rate possible. You know, there's a lot of impact with debt as far as interest rates, where they're at now from a governmental standpoint. And it does trickle down to us in so many areas of our life. And so whenever we kind of think about government debt as it relates to just how it really impacts us. Right now, we're at the highest level of a 30-year mortgage since, goodness, here on the chart, since December of 2000. And so we historically, the last 23 years have been below where we're at now, but at 7.5% is a very high rate. Well, the reality is, as interest rates move up, that affects all of our lives. It squishes down the amount of available expendable cash flow that we have. Now, we do think over the next 3 years, interest rates will go lower on debt. And so if you are locked into a little bit higher interest rate loan right now on your mortgage, if you have one out there, hold and sit pat, talk to your advisor about how that plays in, different strategies to use on that. But right now is the best time to kind of sit pat on your mortgage. And if you have a low interest rate mortgage, definitely keep that in place. But one of the things when it comes down to interest rates, though, whenever rates are higher, it's been very interesting to watch the large corporations. So whenever we look to invest, long-term investing, we look for companies that have a high cash position and a low debt position. And right now, you're going to see a pop up on the screen, just different companies that have a large amount of dollars sitting in cash. And so with that, when you do this just the most recent quarter, the amount of net interest income received by some of these companies. So Apple's is making about $1 billion a quarter just on the cash they have on the books. Google, $892 million. Amazon is a high level. Even Ford, $370 million on interest just on the cash they have on the books. So whenever you're looking as far as with companies to invest in long term, you want to look at the fundamentals of the companies. How much cash do they have on hand? And also how much debt do they have? So if they have a large debt position, more likely that debt they have is a rising interest rate environment. It's a rising interest rate debt because most corporate debt is actually a variable interest rate debt. Whenever they have cash on the books, that means they are able to withstand a recession. They're able to withstand downturns in the economy and be in a better position long term. So when you look at the names there, they're very familiar names that we know, but they're also familiar names that we held inside both our dividend stock portfolio and then also our growth stock portfolio. And so they're positions you want to make sure that you follow along as far as just from a safety standpoint, from a fundamental standpoint. Look for high cash positions right now and low debt positions. If we're in a low interest rate environment, you want to still have a strong cash position, but the debt is not as impactful. Where we're at right now, it's very impactful as far as on earnings moving forward. And so high cash, low debt is the best way to go. The other thing to think through, S&P 500, as you guys know, is made up of 12 different industry sectors. And so it's communication services, information technology, consumer discretionary, industrials, materials, energy, financials, healthcare, real estate, consumer staples, and utilities. So there's 12 different industry sectors. Right now, year to date, as of the 10th of October, so a week ago, and not much has changed since that period of time, but there is only three sectors that are actually outperforming the S&P 500. That's communication services, information technology, and consumer discretionary. All the remaining sectors, the other 9 sectors, are actually underperforming the S&P 500. And what is more staggering to me is that there is 1, 2, 3, 4, 5, 6, 7 of the sectors that have earned less than 2% year to date, actually less than 1.5% year to date. And there is 4 sectors, let's see here, 1, 2, 3, 4, 5 sectors that are actually have a negative rate of return year to date. So right now, the majority of the return of the S&P 500, even though it's 505 companies, is actually constrained to probably the top 30 names that are inside of there. And whenever you look at the previous chart, a lot of them are high cash position names and low debt names. And so one last thing I want to point out to you is that we pay attention to, and this chart's been up the entire time, and you're probably wondering what in the world is going on with that chart and why is it so many colors. And so we look at a number of things, we track a number of things. Whenever you kind of look here, these little marks here is kind of a tick mark, and it's got a little red line up and down or a green line up and down. And so why does it change from red to green? It's, are we in a bull or are we in a bear as far as in a market cycle? And then you kind of say, what are these lines? So this bottom line here is the 200-day moving average. So it's the average of the S&P 500 on the closing price every single day for 200 days divided by 200. Then we kind of look here, and the next one is this little blue line or purple line right here. That's the 100-day moving average. Same formula. You take the 100 days of the S&P 500 closed on, divided by, add them all up, divided by 100. The red line represents the 50-day moving average, so 50 days, and the yellow line represents the 15-day moving average, and so the most recent period of time. Whenever we're looking at this green line in the middle, which turns to red up here, indicates the S&P 500 being positive or going into a negative period of time. And so the last 3 weeks has been kind of vacillating between positive and negative and positive. So what we're looking at, we're trying to simplify what is the overall movement in the market. So you see it moving up, and we look to say, what is the price cross? So right now, the price is above the 15-day moving average, and it's also above the 100-day moving average, but it is below the 50-day and the 100-day. So the two extremes, the 15 and the 200-day, where the price is above it, well, that is a sign it's a confused market. It's trying to figure out where it's going to go. Will it go higher or will it go lower? But whenever you look at this, we're on a downdraft from this point right here. We hit a high back on August the 1st, been going down all the way through October the 16th. What we're looking at, we look at 5 different indices: the S&P 500, the Dow Jones, the NASDAQ, the New York Stock Exchange, and the Russell 2000. Of those 5, whenever we cross through the 200-day moving average on the way down for 4 of the 5, we want to be out of the market. Right now, though, as far as on what we're seeing, is that the NASDAQ and the S&P 500 is both above the 15-day and the 200-day. The New York Stock Exchange, the Dow Jones, and the Russell 2000 are all below the 200-day. So right now the market's trying to figure out what direction to go, and is actually going to be moving up and down. So we listen to the markets, but we also listen to the events of the world. And right now, with what's happening over in the Middle East, it's causing the whole market to be kind of jittery. And so right now we're just watching it to make sure that we do not cross over the next pattern. If we happen to see us cross, if the 100-day moves down lower, or the 15-day moves in the other direction, that'll be a sign for us just to make sure that we increase cash positions. So right now, market is kind of moving in a little sideways motion right here for the last month, trying to find support from what happened selling off at the high point here. Anyway, guys, the markets are moving. We're going to be careful. If you want to increase safety and security, now's not a bad time to do it. Make sure you talk to your advisors. If you're a long-term investor, you're probably positioned very well. Either way, all the things we talked about today, make sure you're in connection with your advisor, and make sure you get information so you can make some good, wise decisions. The last thing I did want to point out is whenever you look at this, this is momentum down here. And so momentum has actually been in a downward trajectory ever since the middle of July. We're going to keep our eye on that. Now, we have rebounded here since the 1st of October. If this continues up, things should finish the year out very well. So anyway, guys, good chatting with you. And as always, a lot of information in the email. Make sure you pull it up. Any questions on Medicare or on Soro as far as debt consolidation, reach out to your advisor. And then also make sure that things are positioned properly between your cash and your equity positions. Anyway, guys, good chatting with you, and I'll talk to you all later on. Bye-bye.